All right. Welcome, Simon O'Connor. Simon is the CEO of Responsible Investment Association Australasia, representing 350 investment organization members who jointly manage over 9 trillion in assets globally. I don't know if that's the most up-to-date number, but Simon has operated in the space where economics, finance, and sustainability intersect for nearly 20 years, including as an economic advisor, investment analyst, and sustainability consultant across finance, corporate, and not-for-profits. He's also the co-chair of the Australian Sustainable Finance Initiative, chairs the Global Sustainable Investment Alliance, and is a member of the Aotearoa, I don't know how well I'm pronouncing that, New Zealand National Advisory Board on Impact Investment. So thank you so much for joining us, Simon.
Pleasure. Lovely to be here. Thanks for having me.
Fabulous. Now, you've been leading the, is it RIA? Is that how we are meant to pronounce it?
RIA is how we talk about ourselves. Yeah. Yeah.
Cool. You've been leading them for 8 years now, which is awesome because I still remember the early days when you started. And you've been working in the field much longer than that, for 20 years. So how much change, can you start us off by talking about how much change you've seen in the financial sector's adoption of environmental and social considerations, especially just in the last couple of years?
Yeah, sure. I mean, just phenomenal amounts of change. I think our organization turned 20 years old last year. And I think when it started, it was this small group of financial advisors really deeply passionate about ethical investing. So it was all about how we avoid harmful industries in our investments. And then through the last decade and a half, that's really shifted to become really as much about good risk management, managing those risks that don't turn up on the balance sheet or the P&L, those what we call the ES and G, the environmental, social and governance risks, or the sustainability risks. And I think the industry is just going through this time of evolving to just professionalize how we understand these sort of non-financial sustainability risks and how we really get our heads around how we value them on balance sheets, on P&Ls, in valuation models, in credit risk assessment. But what's been really fascinating is just the last 2 years, that has just taken off even further. And interestingly, last year when we hit March and the start of COVID, we were sitting there thinking, okay, how's this going to play out for responsible investing and ethical investing and impact investing? And, possibly surprisingly, maybe not, it's really just accelerated the take up there. And I think what it's really done is just highlighted just how real these issues are and how essential they are to be managed for a business to succeed in the modern times we live in, where, as much of the value of any business tuning in here or the big ASX listed businesses is tied up in intangibles and non-financial issues, which is all about what CSR and sustainability is all about. But I think that business case has become clearer than ever. So, as a result, today we can stand here and say we've got 350 members who manage some crazy sums of money in that 9 trillion plus, I don't even know how many zeros that is anymore, but it's really become very much a part of that mainstream consideration for the financial services sector across banking, insurance and investment. By no means have we finished the task though. I think that's what we can sort of dig into a little bit here. It's that the understanding is there. We're not having the debates anymore with CEOs or CIOs or CFOs about how this stuff matters, because it's playing out in our news and our papers every day and with companies every day. So as a result, it's fundamental to the finance sector today to understand these issues, sustainability issues, to the extent that through the Australian Sustainable Finance Initiative, which we drove a big program of work over the last 2 years with about 180 finance sector organisations, banking, insurance, super funds and others. We basically put out a roadmap saying the finance sector has to be considering these issues, has to be aligning with the Paris Agreement, has to be setting in place net zero targets, has to be supporting the SDGs for our fundamental success going forward. And so it's really gotten to that point of being deeply embedded as a core kind of value in this sector.
Yeah, it's amazing that that it has come down to values of, a lot of people think of capitalists perhaps and bankers and people in the finance sector as, cold-hearted and only after the money. And interestingly, that is not as true as it once was.
So, we could have a really interesting discussion around that, because depending who I'm talking to, I can argue that this is a cold-hearted, most smartest way you can invest money today, that you must consider these issues: climate change risks, human rights risks, your communities, if you're to get good investment returns. So depending whether you're there because of your values and desire to do good and do well in the world, or whether you just want to make sure you're protecting your capital and your assets and your investments, we can argue the case for both sides, and I think increasingly we can kind of do both at once, which is the really great kind of shift in that over that period of time that I've been working in. It's not a trade-off anymore. In fact, one predetermines the other, I would argue today. You cannot be a successful business going forward without considering sustainability, managing sustainability. And so I think that argument is clearer. So hopefully we can get to a point where that capitalism is building that better world, not destroying and eroding the future that we all rely on.
Yeah, and I think we are in that transition right now, absolutely. So we were just, before this session, we had Mark Daniels from Social Traders on, and it was really interesting actually how similar the spaces that you guys work in, because they're this gap, I guess. So we were talking with Mark about how there's kind of a gap between the government and the not-for-profit sector. Whereas with responsible investment, you talk about the gap between traditional investing and philanthropy. So can you explain what that means and kind of what spectrum of investment approaches there are within that gap?
Yeah, definitely. So, we would probably argue that traditional investing, i.e. the implication there is investing that doesn't consider sustainability or ESG, environmental and social factors and governance factors, is on its way to being dead, doesn't exist anymore. Basically because we've gotten to a point today where our regulators of the finance sector, APRA, and regulators of corporates, ASIC, are requiring certain elements of sustainability to be managed as a core part of managing financial risk. So APRA is requiring climate risk disclosures, scenario tests, etc. And so effectively, traditional investing, whereby you don't consider environmental issues or social issues or sustainability issues, is really no longer compliant under our financial sector laws. And Australia's been a little slow to move in this way, but in other parts of the world, that's certainly the case, more so than even here. And so I think we'll increasingly see that. But that would, there are certainly some old dinosaurs out there who probably still think that this is, not material. But then at the other end of the spectrum, if you want to sort of look at that, the capital ends of the spectrum is philanthropy, giving money away, not expecting a return. In the broad umbrella of responsible investment, we sit in between those two ends. You go anything, and we kind of alluded to earlier, from very ethically driven, values-based investors who are trying to align their portfolios or their lending or their investments with their values, supporting things they deem to be good in the world and avoiding harmful activities. So that's, involves your negative screening, you're avoiding the traditional areas of tobacco and gambling and increasingly fossil fuels, which has seen a really big spike in the avoidance and divestment of fossil fuels, through to just a pure hard-nosed risk management approach, which we call ESG integration, which is really about your hard-nosed portfolio managers and analysts who are really trying to understand how these issues are playing out to affect the success of a company and hence the share price or the future earnings of a company. And so, that will drive a number of different tools and ways we respond to these issues. So one way of responding to climate change in a portfolio is to just dump all your fossil fuel stocks. Another, though, is to say, well, let's try to transition some of those stocks who may have a role in the future of the energy generation world to lower carbon. And so there's a whole big push going on between what we would call engagement and stewardship, where investors are really putting heavy pressure on boards of directors, on companies to shift their corporate behaviour. And where these aren't successful, you're seeing big votes against company boards at AGMs. You're seeing senior directors and executives being kicked off companies in the last year for various issues that in the past wouldn't have raised an eyebrow. So Indigenous rights issues, sexual harassment issues, failure to consider climate risk issues. And so you're getting investors much more willing to flex their ownership muscle to shift corporate behaviour. And I think we're going to see that through the whole chain of capital, from the big, listed company investors through to private equity, through to venture capital, through to banks and their lending, and indeed through to insurers, what they're willing to insure or not, and how they're going to try to change the companies and assets they're insuring. So there's a lot of different approaches that sit under that broad umbrella of responsible investing. And I think one we might, dig into a bit deeper is also this end of the spectrum called impact investing, where they're actually still trying to get financial returns, but not just avoiding harm, not just managing risk, but trying to create benefit in the world, trying to create measurable good in certain sectors.
Yes, perfect. Yeah. Because I want to dig into that, but I think it's also that gap between philanthropy and capitalism to me is such an interesting space that it doesn't have to be like that black and white, good and bad, that there's a lot in between there.
Mm.
So let's start at one end of that spectrum. So how you mentioned a couple of specific industries and businesses that are being screened already. So what is the sort of approach that investors use to screen these days, of who to invest in and who not to? And what does that mean for SMEs potentially looking for loans from banks?
Yeah, so I think we're starting to see that there are shifting societal norms that are driving an approach to finance and shifting the way capital moves, that are running parallel to regulation and risk and all these other things. But I think we saw a few years ago most of the super funds very quietly dumping all their tobacco stocks. And it became evident that actually they realised that their members, like us, just weren't willing to have our retirement savings invested in an industry that kills people, to be blunt. And so we sort of saw this door just jar open slightly to say, okay, so investors or finance do have a role to play to align with the values of the membership, the beneficiaries, the clients of those industries. And so that has sort of, I guess, snowballed in a sense, where now we're seeing, whether it's banks, whether it's super funds, really trying to understand the preferences of their clients, to ensure they're not investing or lending in a way that runs inconsistent with those. And so we've seen that sort of evolve quite rapidly, whereby, one of the biggest shifts we saw in our annual research that we do each year on this industry is, in the last year, just the big jump up in fossil fuel industries being excluded, or certain subsectors within fossil fuels, namely thermal coal, tends to be a starting point, from portfolios. But I think what's interesting too is we're seeing that move beyond just from an investment lens to a banking lens, where we're seeing a lot of the major banks starting to make quite hard commitments around sectors that they will avoid, that they will no longer do business with, or that they'll try to transition. And so just in the last year, we've seen so many of these under the guise of broader sort of climate change strategies from the major banks, that really means they're going to either avoid or try to reduce exposure in certain sectors. So fundamentally, at the end point of that is that when a bank manager is assessing the credit worthiness of a client, they're going to start asking more and more questions. They're going to be doing more on the due diligence around these ESG and sustainability issues. And that's happening whether you're issuing capital to investors or looking to lend money from banks, whereby they're going to start assessing sensitive sectors to make sure they're avoiding exposure through lending or investments to certain sectors. That could be a whole raft of them. And we're seeing more and more of these policies coming out. So we've got, banks in Australia who have just black banned certain sectors, certain industries. A lot of the credit unions and the smaller banks have been quite black and white to avoid certain sectors. And then the major banks also increasingly are willing to say, we're no longer going to touch certain sectors. And so that does mean fundamentally, they're seeing that there is a bigger risk around lending to certain sectors that they're saying don't have a strong future. And this is ultimately being assessed by a whole mounting body of research that underpins this, that says, there is a higher risk in lending to certain sectors and certain companies that don't manage these issues well. And those more sustainable companies are making better investments and better targets for lending. And so we've seen great research come out on this, saying these more sustainable companies are getting a lower cost of capital, paying lower interest rates because they're more sustainable. They've got more productivity rates. They ultimately make better investments. And so I think banks are starting to align that really deep in that credit risk assessment process in the same way investors are as well, and indeed insurers. And that's only going to be accelerated by this big sustainable finance roadmap that we helped draft up last year through ASFI, the Australian Sustainable Finance Initiative, that really says we need to continue to embed this in that core everyday kind of infrastructure of how we do finance, how we lend, how we invest. And so you're going to see more and more of this elevated levels of due diligence around your ESG or your sustainability, or how well you're paying your workforce or treating your workforce or operating within your community. So I think we would only expect to see that increasingly become a part of any interaction a small business has with a bank or an investor.
Yeah, and a lot of the commitments obviously are around climate change. All of the banks have been coming out with those kinds of things. But they're obviously also having to respond to the Modern Slavery Act and looking at how that influences their lending portfolio. What have you been seeing around how they've been embedding that into their lending practices?
Well, again, I think that's become a huge focus through the finance sector because it ultimately has lifted the level of due diligence they all need to do to understand that very long, often very long supply chains that go in underneath any business they're dealing with. And so we all now have our responsibilities on that supply chain through the Modern Slavery Act. And so, so you're again seeing this elevated level of scrutiny and due diligence being undertaken to ensure there's not exposures through their customers, through their supply chains, to any of these breaches of violations of human rights and modern slavery. And so I think it's just demonstrative of this acceleration and the fact that this is moving beyond just something you may wish to do to something that actually now is a compliance-based, regulated space for banks, for insurers, for investors. And so it means the level of scrutiny and detail that anyone will be asked to provide has elevated massively all of a sudden. You know, no longer is it okay to say, oh, I've got a really nice policy sitting over there in the folder on the shelf that says I'll abide by, and I'll ask my suppliers a few nice questions and they'll tell me the right answers and we'll just tick that box. You know, I think people are going deeper, and people have to go deeper now because of the liabilities and the requirements under law.
Yeah. And with that, normally, I mean, I'm trying to think in terms of translating that to anyone who's watching right now. Is that generally limited to certain types of businesses or certain sizes of businesses?
So I think it necessarily will be. You know, I think what will happen is it'll start with those highly sensitive or exposed sectors will become the start of the key targets for deeper due diligence. And those with, you know, it'll be some form of materiality kind of assessment that says, well, these are the bigger companies that we think are most exposed, so let's start there. But that inevitably is going to feed its way down the chain and start spreading its way out. As you know, there'll be some gentle compliance and scrutiny of those modern slavery reports for the first couple of years, and then the bar will lift and the scrutiny will lift. And so that would inevitably mean that there'll be deeper scrutiny across more of the clients and more of the businesses they're dealing with. So I think you're right. I think it'll start with those, you know, whether it's those most exposed, or in the climate context, those with the highest emissions, or in those sensitive sectors, and spread from there, because it ultimately has to, when you're talking about banks with thousands of business clients or investors with thousands of companies they invest in, there's a practical element to that. But I think you'll start seeing it just turn up as more standard questions in a credit risk assessment process or an investment due diligence process. And so I think, you know, you need to be ready for that. You need to be ready to have done a little bit of work to assess whether you have any risks, and you may well not as an SME. You may go, right, I've done, but you're going to need to be able to demonstrate you've done the work, and you can articulate how you've done that and what it means.
Yeah, perfect. And I guess for those things, it's about understanding what your impacts are. Like the work that you're talking about is, you know, having, and we spoke earlier today, I think it was Gordon Gordon Renouf this morning was talking a bit about curiosity, or at least that's kind of the word that I drew out of what he was saying, is that is how you figure out what is most material in your business, actually, is just wondering, I wonder what is happening in my supply chain, where those raw materials are coming from, what will happen to them at the end of their life. So being willing to ask those questions and start digging, because you will find it.
Mm. Yeah, and the surprises that we sometimes fail to see right in front of us, certain procurement things that you don't ever kind of question until you sit down and you actually undertake a process to assess that. And I think
Right.
that's what we need to be careful of, is that there aren't some hidden risks, hidden exposures sitting there in our little or large or medium-sized business. I think it's really important we've actually gone through the process. And I say that as a small organization with 12 people. We're doing our own sort of processes around this too, procurement, etc. So I think it's really important for all of us.
Yeah, fantastic. Good. All right, so now let's talk about that other end of the spectrum around impact investing. What does that mean, and what does it mean for small and medium businesses that might want to improve their own impact?
Well, it's kind of, I think, the next wave of this whole emergent responsible investing space is really about finance, not just avoiding the most harmful businesses, not just managing risk, but actually trying to align with creating a more sustainable future. And I think there's just been such a focus here, from the biggest end of town to the smallest boutique kind of named impact investors. But effectively, this is shifting the way investors and indeed banking are thinking about their role. Our role as a finance sector today, as we push capital around the economy through lending, through investing, it's realizing and recognizing that those decisions being made every day are shaping our future now, are having an impact now. The companies we're supporting or not supporting, investing in or not investing in. And so I think the finance sector is sort of stepping up to try to own that more and say, okay, so if we are such a big force through an economy, which it inevitably is in any major economy these days, what does that mean for us? Because if we're investing and lending into businesses that are directing Australia to a 4 or 6 degree future, that's no good for me as a large bank in Australia or a large pension fund or super fund in Australia. So you're starting to see banks and investors do a lot more assessment as to what is the sort of net impact of my lending or my portfolio. And often they're doing that around, well, how are we contributing or not towards things like the Sustainable Development Goals? And these SDGs are being used as something of a globally consistent framework against, we can say, okay, we've got 195 countries who reckon these are really important goals over the next decade. That's a good starting point. Let's start measuring progress against those. But from that, we need to really mature very quickly that field. And what we're starting to see is this really rapid emergence of impact investing as a really dedicated part of the investment landscape that is saying, we are going to start measuring how much good we are doing with our investments as much as we measure financial returns on our investments. We're going to get to quantification. We're going to start measuring and reporting and targeting what we're trying to change with our investments. And so you're seeing funds set up to support affordable housing or renewable energy or creating jobs or education or supporting all kinds of goals and objectives. We've seen a massive step up and acceleration of that in the last year. That's grown by about 40%. There's about $20 billion in Australia now being invested through impact products and funds. A lot of others who would say they're doing some good in the world, but not what we sort of classify as really impact investors. I think what's interesting for this SME kind of field is that much of that is looking at venture capital, private equity, private off-market sort of investing to support startups and small companies who are both really good businesses, but also contributing positively to the world. And so you're seeing a lot of these kind of small investment fund managers really seeking out those companies that have purpose built really deeply into their mission. And can really measure the effect they're having on the world, on the the intention of what they're trying to do, as well as sort of generate really strong business outcomes. And so I think that becomes a really nice opportunity if you are a business out there who feels that your whole business strategy is aligned around delivering a really strong mission and really strong outcomes beyond just being a great business that generates lots of profit or returns. I think it offers a new kind of opportunity for attracting capital and strong partnership through the providers of capital, whether that's lending through debt or whether that's through sort of more investment. So it's a fascinating little area that I think is really helping in that small business space as well for those who are trying to do good in the world.
Yeah, absolutely. And so, I mean, it seems like there's all of these new financial products that keep popping up. Green bonds were kind of the first thing on the market, it feels like, less than 10 years ago. Now there's, SDG bonds and I believe social bonds as well. Now there's also sustainability linked loans. Could you touch on those?
Yeah, sure. So if you look at all the big major banks in Australia right now, they're setting up these enormous sustainable finance departments because I think they're seeing the future growth from a banking perspective is in supporting this transition to a sustainable economy. And so it's become this huge area of investment. I mean, you've heard, for example, Macquarie Bank a year ago saying our big growth areas, Macquarie's renewables and impact, like far out. Macquarie Bank of all people saying this is where we're going to generate our outsized returns in our millionaires factory over the coming decade. So it's a big thing and there's money to be made, lots of reasons why you'd come to this space. But as a result, the finance, pointy heads are starting to say, well, how do we deliver structures that can help direct more capital to these kinds of assets that are doing good and supporting sustainability outcomes? And so you're seeing, like you've said, this evolution of green bonds, so lending that's tiered precisely and measurably and is audited that it's only supporting green or environmentally sensitive activities. So you have these big audit trails and these big verification processes and reporting on the use of proceeds and all this kind of stuff. And that's maturing as we see social bonds, social impact bonds. And I think the one that has, we've just seen some news today, I think green bonds are estimated this year to hit something like $800 billion globally of issuance, which is just an enormous step up from a couple of years ago. And I think that'll only increase. But I think these sustainability linked lending can probably just accelerate and double that very quickly, because effectively what this is doing is saying, well, any of my clients, if I'm a banker, could achieve better sustainability outcomes. So we can assess any business we're lending to and say, right, if you manage to improve in a quantifiable and verifiable manner some of your main sustainability impacts, be those emissions, be those human rights, be those any lot of a long list of environmental issues, then if you can meet those targets, we will give you a lower interest rate on your lending. And we will incentivize that because it means you're reducing your risk as a business. And so I think you're going to start seeing all these banks start to talk to all their customers saying, well, what are the opportunities with you as a business? What might we be able to incentivize you improving that effectively from a bank perspective takes risk out of that equation, and we can, give you some discounted kind of interest on that. And so it's just, again, going to start shifting capital more and more towards sustainable activity. So it becomes a great opportunity, I think, to have an engaging conversation with a banker about more than just what's sitting on your P&L and in your balance sheet, which is great because they get it, they're getting it, and they're seeing that these objectives are quite aligned now. And so, yeah, you're seeing some quite big deals going through globally on this front around sustainability linked lending.
Yeah, amazing. And please, if anyone has any questions, go ahead and pop those into the chat box. But first I'll ask any suggestions on how small businesses can be accessing that money. Like, I mean, even some of these green bonds are specific to being able to put efficient upgrades in your equipment or solar panels. There's obviously other grants and stuff out there for that, but that's an option with banks.
Yeah. So I reckon what this sort of says to me is, as you're having conversations with a bank or an investor, I think you can start educating up the chain too, to say, hey, did you know your bank now sees this, the work we're doing over here that, that in the past your banker may not have ever asked about, the fact that you're improving some of your wastewater management processes, or that you've got some enhanced kind of employment conditions with your employees. That means you get much more loyal and engaged employees. Banks are now starting to construct ways of measuring how this improves your creditworthiness and how willing they are to lend it. Now, the person you're dealing with at the bank branch may have no idea about this, but I think there's a chance to educate up and say, we're doing this. And did you know your company's actually been supporting things like this? And it may just be some of those additional kind of triggers to deepen that engagement and get more support when you're talking to financiers. And as part of your whether it's your pitch deck or your lending pitch or how you're talking to your bank manager. But I think it's worth starting to emphasize that these things are real and they're material and they're helping to make you a better prospect and a better target than potentially your competitor trying to chase down the same amount of capital. So it's an interesting time, I think, where it'll take a while for those banks to enforce those policies all the way down that chain, you know. But I think there's a chance to start educating up. And I think also, you know, there's a chance to start putting some competitive tension around the banking industry and the investment industry and say, well, if you don't get it, if you don't get why this actually makes sense from us as a business and us as a potential client of you, I'm happy to speak to the bank next door because I think they get it. You know, I think I've heard their CEO talking about how that works, or and I think there's a nice competitive tension in the market. I've got to be careful what I say here in front of this audience, but that's all right. Between the banks, between the financiers, to have a piece of this pie and to be supporting that. And I think it's a really opportune time to be articulating that really comprehensively as an SME when your approach to financiers in any form.
Yeah, and I know that there are some banks out there who really do try to differentiate themselves in that space, especially the banking on values. What is it? The something banking on values group.
Yeah. And I think there's a couple of members of that in Australia, people like a Bank Australia, I think. And yeah, I think you're right. And it's really interesting to see some of the small banks, credit unions or mutuals who are trying to be quite innovative in this space and carve out a bit of a niche. And I think that's great. You know, I think that's really healthy. But it may be in, that might turn out to be a better place to start with these conversations. Or like I said, it's worth sort of speaking to a few of them just to see how they respond.
Definitely. And you know, if anyone has any questions, pop them in the box. But until you do that, I'll keep throwing other questions at Simon, because I'm wondering. So Mark Daniels was talking a bit about a cooperative that's set up in Yakandanda to kind of save their local petrol station. And that, you know, as you mentioned, there's a lot of cooperative banks and credit unions and things like that. I wonder how much of a role you see for them going forward, including more innovative financial models like distributed lending kind of things.
Yeah, look, I think we're going to see a lot of people trying to innovate to carve out a niche, and I think we're already seeing some of the mutuals and credit unions and customer-owned banks trying to do that, I think, and trying to really align themselves with a particular demographic and a particular set of businesses who are trying to deliver purpose. And I think that is driving innovation in some of the product offerings, both the way who they're lending to, but also the everyday sort of retail banking products you have access to. You know, there are now green term deposit products out there, so you can put your money in a banking account as a business that's actually doing some good while you've got your money there. And there's social impact deposit accounts where, you know, some of your interest can go to supporting other good causes. So there's this kind of product level innovation. And then I think you will see like we're already seeing some of those banks and investors trying to sort of own a space here and carve out a bit of a niche. And so I think that's definitely an opportunity. I think some of the good smaller banks are being quite nimble in this space and are moving quite fast to kind of own it and carve out their position. So I think that's interesting to see how that'll play out, but they kind of need to in the space in Australia where we've got such a dominance by a few large banks, I should say. So
yeah, absolutely. Now I love it. Soren has thrown you a curly question. We like curly questions about the move away from unethical businesses. How do you influence a behemoth company, say Amazon, to comply when they're so profitable and so less able to be influenced by responsible finance considerations?
Yeah, it's the hardest thing in the world, isn't it? It's really interesting. I mean, that's a great example. Because how you do that is you need to demonstrate there's enough of the share registry of Amazon or a big company like that who care about this effectively. And so what we've been seeing is a whole lot of collaborative investor initiatives to put pressure on some of these big companies, because usually you as a sole investor, even if you manage a few $1 billion, probably can't get access to Jeff Bezos and Amazon and their board, and particularly American companies that don't talk to their shareholders. In Australia, you've got really good access to boards actually as investors. But I think how that's played out, one really good example was a bunch of investors led by the New Zealand Superannuation Fund led a big engagement with the major social media companies in the US as an outcome of the Christchurch shooting, where they basically said, you need to take responsibility for what's been streamed and published on through your platforms. And so they got, a bunch of investors that in the end managed trillions of dollars to make the case to them and start putting pressure on them, and started slowly chipping away to get a few concessions, not great, not huge change, but concessions. And I think that's become increasingly a tactic of the investors, is to say, right, we need to show there is a force here of enough investors who care about this. And so you're seeing initiatives every other day really coming through. There was a bunch of investors that put pressure on the Brazilian government saying, we won't invest in Brazilian bonds anymore unless you manage the Amazon burning and deforestation there. We've seen pressure on palm oil companies from investor collaborations. There's a huge initiative on climate change at the moment called Climate Action 100, which is leading investors who have targeted the largest 100 emitting companies and put in place very clear asks for their improvement over time. And so I think that strength through collaboration, which is really interesting, right? Because you don't see investors generally as being that collaborative. They've all been out there sort of to make their own piles of cash. But it's sort of, they're seeing that I think many of these big issues are well beyond what you as a single investor can control, and yet they're going to have an impact over the future returns of your fund. So I think they've awakened to the fact that we need to collaborate. So that's how we would try to tackle something like an Amazon. And then you've got a competition for ideas. Is this the biggest issue? Can we convince investors to put enough pressure on? And it's been fascinating. In 2020, we alluded to earlier, we've seen some major upheavals in Australian companies where executives or directors were booted off because of mismanaging sustainability issues fundamentally. Rio Tinto lost a CEO, senior executives from destroying incredible Aboriginal heritage site, where I think 3 years ago or 5 years ago, we just would not have seen that response to an issue such as Indigenous heritage and Indigenous rights, and I'm sorry to say that, but I don't think we would have. And yet we now have investors who are seeing this as just really critical failures that are demonstrative, I think, of a business who hasn't got its house in order, and some really important issues that are fundamental to Rio being successful. So you've now got Rio who can't negotiate land use agreements. How else do you get iron ore or anything out of the ground without a land use agreement? So how are they going to manage Mongolian governments and Chilean Indigenous tribes, let alone First Nations people in Australia? You don't have access to minerals, you don't have access to metals. That shows you've got a pretty major failing as a mining company. And so investors are willing to really put a lot more pressure on now. So yeah, maybe that's why Jeff Bezos stepped down recently. He was scared. I don't know. We'll see.
He wasn't ready to deal with what was coming at him. Amazing. Okay. Well, I'm going to ask you my number one piece of advice question. We'll see if any other questions pop into the box. So what's your number one piece of advice for a small business looking to tap into all of this responsible investment and capital that's available out there this year?
So I reckon there's a real opportunity now to work with partners who are aligned with your own purpose and mission, to not just see finance as a necessary service for your business, but actually to find a financier, whether that's a bank or an investor, who truly buys into your long-term vision of what you're trying to do and is aligned to that, and that relationship becomes more than just a lending arrangement or an investment arrangement. It actually becomes someone who is a partner willing to see that there's a long-term goal here. And I think it's really encouraging that you then have the potential to find a banker or an investor who will support those long-term plans, who will see where you're trying to get to with your whole mission, who won't get deterred with the fluctuations that are inevitable over the short and medium term. And so I think there's a really nice opportunity to build relationships with finance based on more than just your cash flows, that actually can see through what you're trying to do. So I think that's a kind of exciting opportunity to do more with finance and have a better partnership with finance. And I'm not going to say every banker out there is going to get really excited by your mission, but I think there is a greater opportunity now than ever to find that bank who may just say, yeah, no, we get it. We support what you're trying to do. We want to be a part of that. we're going to partner with you to do that. And so, so I would play into that and really demonstrate how that is actually the work you're doing around sustainability is actually strengthening your business proposition, strengthening your business plan, and strengthening, I guess, lessening the risk from a financing perspective for a banker and investor to support your business. So find that finance organization that aligns with your purpose and buys into your purpose.
Yeah, awesome. And as we mentioned, there are more and more of them out there. So fantastic. Thank you so much, Simon. Now there's a couple of ways that people can keep in touch with you, or some other resources that you've pointed out. Certainly responsibleinvestment.org, your own website for newsletters and social medias, etc. Also responsiblereturns.com.au. Can you mention a bit about what that is?
Yeah, look, that's our sort of online tool to make it easier to find investors and banks who are certified through RIA. So we've done a big, deep due diligence on the credibility of the claims they're making around responsible and ethical claims, and whether that's exclusions or what they're doing. We certify them, and then we put them up on that website, making it easier to find a banking product or an investment product or a super product and you can sort of search for that via your own personal values and the things you care about a lot. So there's about 200 products across Australia and New Zealand through there. And we're kind of tightening the screws on these product managers to make sure they're really, true to label, demonstrating and proving what they're doing, and able to actually, verify that that's true. So go and use that as a resource, and we're continuing to build that out in terms of having some of the information around that as well.
Awesome. So that's a good way to find that partner, I think. All right, perfect. Thank you so much, Simon, for your time. That was super, super valuable. Everyone in the chat box is saying thank you so much as well. I will post those two resources into the Facebook group, which I've just posted there. And that's it. Thank you so much for your time.
Thanks so much. Yeah, pleasure. I appreciate the chance. Thanks.
Okay. Cheers.